Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. Yeah, so I think let's just kick it off. And maybe, James, if you want to give a background of who you are, where you've been, how you've got to where you are.
Yeah, sure. So, firstly, thanks for having us on board to do the podcast in the first place. But I think dialing back to, I suppose, how I got involved with crypto in the first place is really back at the start of 2017. And, just got involved through with friends that were playing around with it, and fortunate in terms of time in that it really got on at the beginning of what started to be, a first of probably, second or third in terms of the broader scheme of things, but one of the big rides or booms of crypto during 2017, and then unfortunately, the bust of 2018 from there. But I suppose, I sort of stuck around after that bust sort of period, as I sort of saw, a lot of the technology that was sort of being visioned in some of the white papers that these cryptocurrencies that came through the initial coin offering phase were, sort of designed to try and build, and saw some really interesting tech here, and was really, struck and attracted to what could be built here. So stuck around during that period, which was, as it is now, or as it is now termed, sort of that crypto winter period where everyone sort of rushed away and prices dropped, 85, 90%, which is naturally quite scary in the scheme of things. But stuck around during that time, we really start to see these companies and projects start to execute on their roadmap and start to build what they were designed to do. And that kept me quite involved. I was quite involved with a couple of communities within the projects themselves. And, that interest and that excitement still continued to grow as time went on. And we sort of see ourselves in a period where, a lot of these good sort of projects have started to come into fruition. Obviously, a lot have, fallen by the wayside and just not executed on what they were designed to do. So there's undoubtedly been a lot of projects that have gone bad, but the good projects have really, maintained a lot of interest, and, some have begin to fall into this bucket known as, the decentralized finance or DeFi sector that we're now sort of calling it. But I suppose I've been following this as more of a passion, more of an interest, researching, investing in the space outside of work hours. I come from more a traditional finance sort of background, aside from, other backgrounds in crypto, whether it be sort of a computer science background or engineering background, or, just a passionate techie, very early on. I suppose my sort of traditional background is within sort of the asset consulting space and investment research area. So I recently finished up from Frontier, where I spent about 2.5 years there, and was doing both client consulting side, whether it be portfolio construction or asset class configurations, as well as from a research side doing fund manager due diligence as well. So I spent 2.5 years really learning how these big motherships, these big institutional investors construct their portfolios and deploy capital and the like. So it was very, very useful, very valuable experience. And then I suppose prior to that, in a former life before Frontier, I was at PricewaterhouseCoopers for about 10 years. And that was in a mix of roles, whether it be, a specialist tax area or a more general tax area. And then towards the back end of that 10 years, it was within the private wealth division within PricewaterhouseCoopers. And that sort of then moved through to Frontier. And here's where I find myself now, making the full-time jump into crypto as an independent investment analyst. And I really made that decision because I wanted to capture a lot of the growth and the innovation that was going on, especially in the DeFi sector. And I just, as with a full-time job trying to do this after hours, your bandwidth is quite limited, both the quantity of hours you can put into the research and the investing side, but also your mental bandwidth to be able to absorb information. So if I really wanted to jump on board with the growth and really try and cover as much as I could with regards to the innovation that was going on in DeFi, I really had to take a bit of a risk and a bit of a leap of faith into committing to this full time.
So I guess one of the biggest things that I always think about is there's a lot of people moving into crypto more broadly, and you can look at every different new coin that's been put to market of late. I think there's over 5,000 coins that are available trading all the time, huge amounts of volatility. So it's captured a lot of people's attention. I don't know if it's caught the attention of instos really in the Australian market. Globally, there's a few people that are playing on it. You've made a pretty clear decision to sort of move away from crypto as such and talk more around DeFi more specifically. I'm just curious around, how do you see those two as being sort of separate but connected?
Yeah, sure. So I think, the crypto industry more broadly, as you say, is so diverse. As you said, around 5,000 different coins. The idiosyncrasies between them all is just, phenomenal in terms of what one coin does versus one coin versus the other. Now, typically sort of the headline, household names will capture a lot of the attention of the media and really and become quite sensationalized, whether it's the large drawdown we had within Bitcoin or more recently, or whether it's Elon Musk sending a rogue tweet that he's invested in it at the start of the year, and then sort of going a little bit backwards on his words with regards to Tesla not accepting Bitcoin as payments. So it's, and especially like within that, there's other ones like Dogecoin and the like that again are these sort of household somewhat names, but very sensationalized and really carry a lot of speculative value. And I suppose I try to come at it when we get to talking about the DeFi sector is really trying to, apply a little bit more of a fundamental approach to thinking about cryptocurrencies. And I suppose that's where we sort of arrive into this DeFi sector. And this is what's really got my attention, where I think there's actually quite a lot of interesting activity that's going on, is because that tokens and protocols that are starting to get captured in this DeFi sector are starting to gain quite a lot of adoption, whether it's users starting to use the protocols or people who are providing capital into the protocol are starting to do that more frequently now, as well as these protocols starting to generate cash flow. So when you start talking about cash flow, and when it comes to these protocols generating that type of revenue, you could start to build a case for starting to throw a little bit more of an intrinsic or fundamental value on particular cryptocurrencies and particular protocols, aside from the typical speculation, which is sort of surrounded and to be honest is quite a blanket concept when it comes to crypto and investing in crypto.
How do you then think about the mania that is within these crypto assets, and then you start to talk about the value that sits within these protocols? I guess for most people, they don't understand how value basically attracts, or how does the value basically grow within the protocol, or is it within a particular token? How does that value grow alongside the growth of that underlying system?
It's a good point, trying to dissect and draw the parallels between that value and the network itself. And I suppose it sort of comes back to sort of the definition of, or the sort of loose definition, and again that's a static definition. It's quite evolved in the actual space, but I suppose it comes back to that definition of DeFi, which is essentially taking traditional financial services and conducting those financial services in a decentralized manner. So it's taking out your third parties, you're taking out any intermediaries that are typically used with regards to typical financial services, whether it be derivatives, whether it be payment networks, whether it be short-term credit networks, short-term credit markets, or typical exchanges or market maker environments. And you're taking these quite primitive financial services and putting them in this space where you can essentially operate in a peer-to-peer framework and use the blockchain as this governance network to bring all parties together. Now, within that stems from a couple of key pillars, which is this idea of having economic incentives, having smart contracts, and having a blockchain that is used to influence user behavior and attract users and keep them, I suppose, engaged in such a way that you can create quite a sustainable and living and breathing ecosystem. And within that, you get to this idea or this iteration of financial services relationship, which is a peer-to contract or a peer-to pool type of function where a user can rock up to a protocol that's offering a particular financial service, and they can transact as a peer to a pool and affect that particular financial service that they're getting or they're wanting to get, and they can pay a fee for that service. And in exchange, they'll obviously receive the service, but that fee that gets taken away by a particular smart contract will then go to the people who are sitting in aggregate on the pool side, providing that capital.
Can I pause you there? How does that actually work? Because if I think about it from a Visa or MasterCard sort of system, they provide a network, a payment system. They get a fee as the system works, right? Now, if I think about the crypto blockchain style approach, which is this decentralized market or network that's been created, how does the value then get attributed to the participants?
Sure. So I think it comes down to, I suppose, sort of when you're comparing it to Visa versus a blockchain, they're similar in the sense that they're both operating what is a ledger system or a database system. And they'll, whether it's, Visa on their end, they'll do the matching between accounts. Say if you send, funds from one account, one Visa account to another, or even in PayPal as another example, your one PayPal to another PayPal account, it's essentially a ledger system that you're going minus in one account and plus in the other in terms of a debit and credit. Now, in the blockchain environment, it's essentially the same thing, except rather than one company conducting the ledger, you're using a number of individual computers that have their own ledger who are working together to ensure that ledger is correct. So when a transaction goes minus in one, say, Ethereum blockchain wallet, and send it to another Ethereum blockchain wallet, that minus and that plus is agreed upon by all computers that are maintaining that blockchain. Now, where the economic incentives comes into play is that why would a node or a computer want to manage or assist in verifying the network? Well, when you send a transfer similar to PayPal, you'll have to pay a little bit of a transaction fee, which will go to PayPal or Visa, and that's their fee for conducting the transaction. Similar in a blockchain example, where you will pay a fee in order to send a transaction, and that will go in an aggregate fashion to the computers that are running or verifying the blockchain.
Doesn't that sound a little bit more inefficient than a simple system of Visa where there's just one party? It seems like you've got multiple parties trying to satisfy the node, making sure that all the nodes are acting in accordance with this blockchain.
I mean, we talk about sort of like the inefficiency side, and you're right. When you've got just the one system, in Visa or PayPal's example, that's managing the one ledger, quick, it's in one, out the other type stuff. And in a blockchain example, what you can see is you can find blockchains with a small number of computers that are managing the network, and that in itself can be quite quick when all of them agree on the particular transactions that are flowing through. And the more computers you add to the network, naturally it becomes a little bit slower when you've got a large number of computers trying to agree on everything. But I suppose where the benefits start to play through is where there's payment networks which are going international, and you're having to deal with say a financial institution in, say, Australia and a financial institution in, say, the US or Europe, and using PayPal to sort of come over the top and affect that transaction. You've also got a SWIFT system in the background as well. And these international payments can take 2 to 3 days or so to arrive or deposit in another beneficiary's account. But in cryptocurrency land or in that blockchain land, being able to affect that transfer can be a lot quicker. It can be a matter of minutes.
Is it a fair assumption that some of the benefits that has come through this ability to be efficient in moving money around the world is really almost a regulatory arbitrage piece? Because Visa and MasterCard and PayPal have got a lot of regulations around them. Blockchain still, or these types of cryptos are still very much in their infancy. There's a regulatory benefit for them at the moment.
Yeah, it's a great point. And I mean, it's I suppose one of the risks more broadly with investing in the crypto space is that there is this element of regulatory risk or regulatory arbitrage, whichever you want to call it, that you're involving yourself in, because the tech has been so innovative so quickly that it's actually leading regulation at the moment. And regulation is catching up, but because the innovation is so quick at this stage, there is an element of catch up that regulators are playing and trying to work out, well, how can we regulate this environment?
Is there also a challenge around sort of trust in the networks in terms of their scale? So as these systems start to scale, the amount of nodes that need to grow, is there an increasing number of parties that you need to be able to maintain scale? Or are there efficiencies that come from the growth of these types of networks, or is it just we sort of hit a plateau in efficiency on these things?
Yeah, it's a great point. I mean, the household name being Ethereum in terms of scalability and capacity is within their sort of, I guess, number one priority at this stage, because they were one of the first public blockchains that is now, as I said, a household name. A lot of decentralized applications are being built on it. There's a lot of users, developers, interacting with the blockchain itself, and it is starting to get to a level which is just at capacity. And how we can measure capacity is the level of fees that these individual computers that are managing the blockchain, the size of the fees that they're needing to charge in order to compensate them for the computing power that they're giving up in order to maintain the level of transactions that are being transferred and transacted on the blockchain. So we're pretty much at that level in terms of maxing out capacity and looking for scalability solutions at this stage. Now, there's a number of sort of enhancements that are being looked at, which are known as sort of layer 2 sort of additions or enhancements, which basically are attempting to speed up the process and being able to essentially conduct your own mini transactions on this layer 2 and then settle the net sort of transfer on the actual layer 1 blockchain being Ethereum. Dive into the weeds a little bit, but I suppose the point is that the levels of transactions are at capacity, but there are things like layer 2 as well as Ethereum going through their 2.0 change of consensus algorithm that is addressing these scalability issues, because otherwise it's always going to be just a backyard project type of tech and not trying to get to where it's intended to be, which is a mainstream public settlement layer.
So I'm trying to sort of get my head around where the value is accretive to. Is the value accretive to the actual token itself or the value of the network? I guess for a lot of people, when they're buying crypto assets, they feel that there's this excitement around the crypto asset and that's where the value sits. But is the value really sitting in the power of the network and the amount of transactions that push through that network?
Yeah, it's a great point. And I suppose we're just talking about Ethereum then, but sort of diving deeper into the DeFi sector, where we're starting to see a lot of these protocols generating cash flow. There's typically tokens attached to these networks, and each token will vary in terms of the characteristic on what that a token holder is entitled to, whether it's governance, voting rights over to with regards to how a protocol is governed, or whether you're entitled to say a portion of the fees that are generated from that particular protocol. So it's really dissecting at a token level what are the characteristics of that particular token, because you can draw this distinction where it's, well, we see a lot of value, whether it be volume being generated in a decentralized exchange or a level of, say, assets under management per se that's being locked into these particular protocols. So the actual protocol itself is being used and generating cash flow, but those fees are just paid from users to the capital providers within the network. So you can have a token, which there's tokens out there which are purely just governance tokens. They are just designed to make decisions on the direction of a particular protocol. Now, what's interesting is that these tokens, even though they're just governance rights, can have quite some substantial value. And you sort of question, well, what is the fundamental intrinsic value to these particular tokens? Because if it's not generating cash flow, well, is it just, I guess, speculation? And this is where, to your point, you start to dissect, well, a protocol itself can have a lot of users, have a lot of capital within it, and the fees generated can go directly to the capital providers. And you can have tokens which are associated with the protocol, but in terms of actually accruing that value that's created by the protocol can just be non-existent, but it can also have tokens which are entitled to particular fees, so that you've got this concept where the protocol creates value and the token can then accrue that value as well.
I guess one of the things that probably for the audience would like to hear about is what sort of real economy examples are there, where DeFi can really be applied maybe today? Is it
Yep.
sort of around lending and borrowing? Is that to me seems to be the place that's of most interest, particularly around trade finance, where there's a constant need to have smart contracts to track things as they go through the process, to make sure that the underlying collateral is there. Is there other options or other applications that you can think of?
Yeah, definitely. So there's another subset of DeFi, which is in this decentralized exchange subset. And within this decentralized exchange subset, you've got a pure peer-to-peer order book type of approach, but you've also got what's known as an automatic market maker approach as well, which is essentially quite a disruptive version of your traditional market maker environment. And if we think of some of the high-level characteristics about a traditional market maker, they'll hold stock or liquidity on their own book in order to build a market, and anyone wanting to transact through that particular market maker will incur a fee for doing so, and that fee will be somewhat commensurate, almost commensurate with the size of how much someone's willing to transact relative to the size of liquidity that particular market maker is holding. If that particular trader or user is looking to trade quite a substantial portion of the order book or the liquidity of that particular market maker, well, the market maker is going to translate that back to quite a substantial spread or slippage that they're going to have to pass on to that particular trader. So casting that back to this automatic market maker idea, you can essentially take out the market maker as an intermediary or a third party, and you replace that with people with excess capital that are willing to pool capital into the network. And then you've got a user or a trader that can trade through that protocol and through those liquidity pools, whether they want to trade out of Ethereum and into another cryptocurrency or vice versa. And it's a similar idea. If that trader wants to trade quite a large portion relative to the liquidity within those liquidity pools, well, the algorithms within this particular network will adjust the fee accordingly, and in that example, will incur quite a high slippage in order to compensate for them taking quite a large portion of those liquidity pools. And then that fee essentially goes back to those people providing liquidity. And what you've done then is you've turned your excess capital into now an income generating or income yielding asset. This is all governed by smart contracts and code. So there's no third party or no intermediary that's governing this process between a user and a pool of assets.
One of the other places that I guess comes to mind when people think about crypto is stable coins. How do they fit in with the whole system?
Yeah, so stable coins are an essential part of the broader, I suppose, system from two areas. And the first one is just from a payment channel or a payment vehicle that is with incredibly lower volatility compared to what Bitcoin was designed to do as this peer-to-peer decentralized network. So having stable coins in the market is very useful, and they've seen incredible growth in terms of the amount of stable coins within the market themselves. And it's also used as just a sort of this low volatility asset to liquidate into. If you're, say, a trader or you're holding a position that you want to sell out of, you can sell into stable coins as that low volatility source of asset. Now, stable coins is interesting because it comes in sort of two key forms: a centralized version and a decentralized version. And the centralized version is basically a little bit of a crossbreed or a hybrid between the real world and crypto, where you've got a third party which will take people's deposits, and in a one-to-one ratio, they'll issue a stable coin in sort of the cryptocurrency world, and they'll manage the liquidity and the buying and selling in order to maintain it, or make sure that peg remains at whatever that it's pegged against, whether it's US dollar or a hard commodity. Now, you've also got these decentralized type of stable coins, which are basically, again, coming back to a network protocol, is basically governing a process to maintain the peg of a stable coin, whether it's pegged against a fiat currency or it's pegged against a hard commodity. Now, the interesting part about the decentralized stable coins is that these, in terms of adoption, these are being used at the moment. We're starting to see quite strong traction with regards to countries that are currently going through high inflation periods. So especially in South America, when we're talking about Venezuela, we're talking about Argentina, there's decentralized stablecoins which are pegged to the US dollar, which are now being used as a form of store of value for residents and citizens domiciled in those countries to buy these assets or these decentralized stablecoins and use them as a hedge against inflation and sovereign risk and the like.
We've got to touch on some of the risks that are within this space. I think one of the things that's really fascinating is you mentioned at the start your previous role at Frontier around sort of talking with institutional asset owners and so forth. I think it's been a pretty big leap for many of them to think about crypto and even some of these new developments that have come in. And then if you think back to the history and the development of crypto assets historically, particularly around Bitcoin, it was the ability for these coins obviously to be created, have some semi-privacy attached to them, have a bit of a decentralized approach to them. But now as we keep moving through the process, it feels as though it's becoming more and more institutionalized. And so those benefits that were there and the excitement alongside a lot of these things is now starting to wear off because there's now more institutional players coming in. There's now a lot of custodial services coming in. It's becoming much more sophisticated. How do you think about the risks of institutional players coming into that market and how that could potentially change this whole space?
Yeah, so I think it's a really interesting point, and this will be part of a bit of a research paper that I want to look into over my next journey. It's really starting to characterize these assets from, I guess, an institutional landscape or a traditional finance landscape, like for Bitcoin as an example versus DeFi. Where do these things sit in terms of a total portfolio perspective? So Bitcoin's, it originally was issued to be a peer-to-peer network, but because of its extreme volatility, it makes it quite difficult for me to say, well, I'm going to pay with Bitcoin, or I'm going to settle a house or settle a car, whatever it is, in Bitcoin. If it takes a couple of days or if it goes through overnight or whatever it does, it will, undoubtedly change. If it drops 5-10%, well, there's obviously someone who's got to make up that 5-10%. But it started to morph into this new narrative, which is this store of value, where it's basically this currency that sits on top of, it's not governed by any one central bank or any one sovereign. So it kind of sits and is a bit of a hedge across sovereign risk. But what I see personally at this stage is that the characteristics of this particular asset class is it's still such a speculative asset rather than a hedge. We go through periods where this thing can go down 50%. Like the drawdown characteristics are phenomenal, or the actual daily volatility or monthly volatility can be magnitudes higher than traditional asset classes, whether it be listed equities or property or the like. Now, what's interesting from an institutional landscape, which I think brings a lot of insight, is being able to shed light in terms of understanding, well, what is this asset class? What are the characteristics of this asset class? And start to sort of reduce, I guess, the information asymmetry that's currently present in the broader asset class, so people can start to see some predictability and start to then look to include it in, or some more from an education point of view, start to work out where this fits from a total portfolio perspective. Then you can look at it from another angle, which comes to sort of the flows. It's the flows of capital. So as institutional money starts to come into the market, we start to get a level of mainstream. So there's a lot more liquidity now coming into the actual asset class itself. So undoubtedly we're going to have these peaks and troughs of booms and busts, but on the long term, those are going to start to iron out. And we get to a point where a lot of these characteristics we're currently seeing now, whether it's major drawdown characteristics or relatively high volatility start to dampen away, because it does become a more of a mainstream asset. And I think that's where the institutional capital coming in can really, contribute to that becoming what I think it's intended to be, which is that hedge of sovereign risk down the track.
It's an interesting approach to looking at it, which is the hedge to sovereign risk. These institutional capital pools, particularly in Australia, are almost de facto sovereign players anyway. So it's a real dichotomy there you're trying to solve for. But I'm curious around, for institutional investors as they think about crypto style assets or the networks, what's best for them to sort of think about in terms of where do they look, what do they look at first as a way to get maybe exposure to this type of market? Do they look at these new types of networks, understand the way these networks are working? Is it around particular tokens that pay a return, for example? Where should they look?
Yeah, it's a good point. So the way I see it is basically Bitcoin and DeFi, and obviously there's a lot of other stuff going on there, but I suppose they're the ones that you can sort of start to put a little bit more of a rational, if that's a bit too concrete, very loose, rational sort of thesis behind. When it comes to DeFi, you're able to start seeing cash flows spit off protocols. You're starting to see tokens that are entitled to these cash flows. So when it comes to some of these traditional finance experts, especially in the equity space, that are conducting market comparable valuation or discounted cash flows, you can start to loosely apply these valuation methodologies to some of these tokens that are starting to generate cash as well. So it's much less of a finger in the air or much less of a dartboard when you start focusing attention on tokens that are generating cash flow, especially within this DeFi space. And DeFi is essentially the hunting ground for these types of assets that are tokens entitled to cash flow. So I think from that point, that's your starting point. You can have Bitcoin in there, but you've got to understand the characteristics that if you think it's a hedge against sovereign risk at the moment, well, it's, in my opinion, at the moment, it's currently not there, even though I think it can get there. But given the great drawdown characteristics and the volatility, as long as you know that it's a speculative asset rather than a hedge, you can size it appropriately and you can view it that way. But there's the Bitcoin example, but then also focusing on the cash flow to the tokens in the DeFi example as well. That'd be the best way to look at it, I think.
All right, that's been a fantastic conversation. Thank you very much for your time today, James.
Absolute pleasure, Alex. Thanks for having me on.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.